Thanks for joining us, David, Kevin, and myself, for the market update for the month of October. I'm super excited. We just finished Halloween, and it was just awesome seeing all the little kids come to the door. As always, before I pass it off to David and Kevin, if you have any questions, please don't hesitate to give any one of us a call. Take care and enjoy this market update from David and Kevin.
David, how did investment markets perform in October?
Well, after a challenging month of September, we saw a really strong bounce back in the markets in October. U.S. stocks, as measured by the S&P 500, were up 8% in the month. Canadian stocks, as measured by the S&P TSX, were up 5.25%. And elsewhere globally, we also saw strong performance, particularly in European markets, which showed positive growth anywhere between mid to high single digits, depending on which market you were looking at. Kevin, what drove that positivity in October?
Most companies have now released their third quarter earnings, and though some companies did disappoint, many companies showed much stronger earnings than anticipated. Sentiment and expectations were already pretty low, so these positive earnings have really caused the market to rally. The Bank of Canada, as many will remember, was the first G7 nation to start raising interest rates earlier this year, and now they're the first G7 country to start to slow the pace at which they're tightening. Many people predicted that the Bank of Canada last week would raise interest rates 75 basis points, and in the end they only raised them 50 basis points, and their rhetoric was much more dovish. The bank spoke about still wanting to combat inflation and bring it back down to target, but that they would be much more patient and they would really monitor the situation and react accordingly. Now, there is no guarantees, but the hope is that the Federal Reserve will follow the Bank of Canada's tone and might have a similar rate increase when they do their numbers. David, what is the outlook on bonds?
Well, speaking of the Fed and the Bank of Canada and the fact that perhaps we're starting to see the acceleration of these interest rate hikes start to decelerate rather, that could be a really good thing for the outlook for bonds in the short term. So over the next 3 months or so, we do expect interest rates to continue to go up. But again, it's all about the pace at which that happens and how the central banks are telegraphing what's going to transpire and what their rhetoric is like. But basically, and for the past 12 months or so, bond prices have been trading down because interest rates have been going up. Once interest rates start to find a level and they stay there for a while, we're going to benefit in a couple of ways. Number one, prices will quit being marked down, so your prices will become more stable, and also the yields or the interest rate that you're receiving on your bond portfolio is now going to be much higher than it has been for at least a decade. So a lot of bond fund managers are talking about 2023, 2024, 2025 producing high single digit, maybe even double digit returns in the bonds for a period of a few years, once we get interest rates to a point where it's clear that they're not going to go any further. So again, that's still probably 3 to maybe 6 months away, but the market and many economists are hoping that by early to mid 2023, this current rate hike cycle will be complete. And obviously just listening to the central banks and seeing the data come in will give us some insight into when that's going to happen. But yeah, as always, if anyone has any questions with your portfolio or the markets in general, please don't hesitate to give Harry, Kevin, or myself a call.
Take care.